Hi, I'm Jeff Hirsch here at the Money Show with Marilyn Cohen of Envision Capital Management. She's the president and CEO there, envisioncap.com. And you're talking about one of your presentations here is the Fed and getting to normalcy. Can they do it? How are they going to do it? What does that mean for the bonds, right?
Right.
So,
big topic.
Big topic, the Fed. I'm kind of happy with Powell, though. I think he's...
So far, so good.
I think he's impressed people.
Jeffy's going to do exactly what he says he's going to do. He's going to continue to increase rates this year.
Sure.
So, increasing rates in a good economic environment like we have shouldn't be too jarring for the markets. But it has
However,
been.
However,
it has been. Because we've been used to low rates for so long.
That's right.
And I say, bring it on. My clients that live on their income, they have been living on paltry trickles of yield. Now, there's some meat to it. So there's a downside, there's an ugly side, and that is if you own bonds, open-end funds, closed-end funds, ETFs, individual bonds, the value is going to decline as interest rates go up.
Right.
Everybody was afraid of 3% on the 10-year Treasury. Well, we're here, and the world has not come to an end. Historically, that's a very low rate. So
super low.
I think there's going to be collateral damage, though. And that is, number one, how does the Fed go from an $800 billion balance sheet to a $5-point-something trillion balance sheet? That wasn't normal. Now they're going to start letting those bonds roll off. That's not normal because that means we're going to have more bonds in the system that have to be bought from outsiders. And people are worried about that. I'm not so worried about that because our yields in the U.S. are higher than any other sovereign debt nation. So there's a lot of push and pull going on, but I think that...
So what does that mean for the bond market?
It means that rates are moving up. We, as day follows night, will get to an inflection point where interest rates get to a point where it starts to choke off economic growth. You'll see that in earnings.
The old 3 steps and the stumble?
Exactly. You'll see that in debt service coverage that the corporations are struggling with and the municipalities. So,
and the federal government.
And the federal government. So that would mean a recession or a slowdown, right? So we've been rocking for quite a long time.
We have.
You know, we not at that 3% GDP like the Trump
it's 10 years since the recession.
Exactly. So it's...
There's going to be another one at some point, right?
Yeah, that may be closer than we think.
How much closer?
You know, I think if they really raise rates another 2 or 3 times this year, it could be sometime in 2019.
Interesting.
Just be prepared, that's all.
All righty. Well, thank you, Marilyn. Thank you, everyone, for joining us.